Small cap stocks definitely don't receive the same hype as their larger peers, but should they have place in your portfolio? Of course they should, because that's where the real growth is. The JSE has got more than 400 shares, 40 of which are blue chips, another 60 make up what they call the midcap index. The rest, the other 300, some of them might just be gems. This is the MoneyMakers. I'm Bruce Whitfield, here to talk about small caps, the how and the why, the when and the what of small caps, which you should be eyeing to grow your portfolio. Joining me is from Alpha Wealth, Keith McLachlan. You're small cap mad, aren't you? I mean, out of the universe of, say, 300 smaller cap companies, how many are actually worth investing in?
So just because a company is listed doesn't mean it's worth investing in, and this is particularly true in the smaller cap. As you go down the market into the smaller and smaller businesses, they tend to, on average, be worse quality because the balance sheets are smaller and the like. So of those 300, if you just look on standard deviation, you'd assume that over half of them aren't worth holding.
Okay, but is it as simple as saying, right, we go from the top 100, fine, small and large and mid caps, the next 150 are worth looking at, and the bottom 150 are not worth looking at? Because that could be a silly rule, wouldn't it?
Definitely not. Size does not correlate to quality of business, one to one. Now, there is a relationship, but it's actually not as direct as people think. There are smaller businesses that are much better quality. Have a look, for example, at the Capitec. Now, Capitec sitting in top 40, but for the vast majority of its life, it actually wasn't. It was sitting in the small cap index and moved into the mid cap index and very quickly moved out into the top 40. So Capitec was a small cap, and it's one of the best quality banks in South Africa, and likewise. So key criteria I'd look in this part of the market is look at returns on equity. Look for as little debt as possible, as higher returns on equity as possible, good growing, organically growing revenues. These are all good characteristics of a good business matched with cash flow and valuation, and you start to get a very attractive prospect.
Why do so few people pay so little attention to small caps?
I'm going to be cynical here and say because on the one hand, they have to do more work. And on the other hand, that work can't be done for them. There's less research in this part of the market. You can't rely on brokers and broker consensus, and in many cases there isn't sell-side research. There's lots of companies, so you actually have to get out of your chair. You actually have to read financials, meet management teams, go on site visits, and dig through this part of the market. And the average market participant wants to go and raise assets and doesn't want to actually go and do research.
Now, and that's the problem with the small cap sector, but it's also the wonderful opportunity that the small cap sector represents, because there are a handful of you guys who do make the effort.
7 at this point.
7? Is that all?
7 small cap fund managers in South Africa. And sure, there's lots of people looking at this part of the market, but call me crazy, I like uncrowded parts of the market.
No, it makes the most sense, and it's also where you run the best chance of getting exponential growth. The odds of give me a company, a Rolfs.
ShopRite.
Okay, but
Rolfs,
a Rolfs, for example. What sector is it in?
So Rolfs is in the chemical sector.
In the chemical sector. So the odds of a Rolfs going up by 10 times is considerably higher than a Sasol or an AECI going up 10 times,
absolutely,
right?
Absolutely.
So $100 spent in Rolfs is a better bet than a Sasol or an AECI. However, most of the market would choose Sasol and AECI over Rolfs. Why shouldn't they?
Well, consider it on, and now everyone throws around terms like risk adjusted. I can explain that even simpler. Rolfs is growing at a faster growth rate than AECI and Omnia and Sasol. Rolfs also has a lower valuation than AECI, Omnia and Sasol. So the combination of a higher growth rate and a lower valuation, that over time that growth rate makes it bigger and bigger and pops it on more and more radars, and that means that the stock re-rates, but in the meantime its profits have doubled, tripled over 3, 5, 10 years, and you get the combination of positive re-rating of the multiple in the market and bigger profits, and you start to get exponential returns. Whereas in the larger part of the market, for example a Sasol's future is largely dictated by the oil price. Everything else is analyzed to depth and efficiently priced in the market. There is very little re-rating in Sasol. It's just quite simply how the rand moves, how the oil price moves.
The odds are, to the layman, that AECI is more likely to be around 5 years from now than Rolfs is.
I wouldn't necessarily agree with that.
There we go.
So consider balance sheets, consider scale, consider cash flows and profitability. And So AECI might be a bit of a difficult example because they've got a land bank that they can utilize. But like an Omnia is perhaps a cleaner comparison to a Rolfs. And Omnia went and built a whole lot of factories, and they make fertilizer and explosive. Now, if you have a situation where you have a drought and no one's mining, well, you get limited volume growth, if not negative, and it contracts. And building a big factory that for the last 10 years sounded fantastic means you have a huge amount of overhead. So that unwinds very quickly backwards. Where Rolf, being a smaller player, can be a lot more flexible, a lot more adaptable, and go and utilize its small scale and its nimbleness to quickly build on bulk elsewhere. That an Omnia perhaps is not relevant to it. It just doesn't look there. Rolfs can go and do a R1 billion acquisition tomorrow. Yeah. That will double the size of the business. Omnia wouldn't even move the needle.
Oh. Okay, so but that's what's compelling about the small caps. Give me another one.
Consolidated Infrastructure Group,
and
CRL. Their underlying subsidiary is Conco that builds effectively or has power order book with Eskom municipalities and predominantly actually in Africa, substations and the like, and transmission networks. Conco is high margins, growing order book, very strong niche player, as opposed the rest of the construction sector that has been decimated is pretty much a commodity. I mean, do you really care who builds your bridge, your house or your shopping center, so long as they do it cheaply and it works and doesn't fall apart? A substation, not everybody has the skills to build that. So CRL, having Conco, its order book's been growing at 20% year on year. It's on a single digit multiple. So you're paying about 9 times price earnings for a business growing at about 20% year on year for the next 5 or 10 years. And you get Tractional, which is a railway business in there. You get a building materials business. You get an oil services business. You also recently, their big acquisition was Conlog, which does prepaid meters. Not just in South Africa, across the whole world.
Conlog was dodgy at one time. I mean, Joe Modise was involved. He was the chairman. He was the former defence minister, of course, the arms deal and all of that sort of stuff. But Conlog, I think, has shed that history. Are we comfortable with that? Are we confident with that?
So my understanding is they bought them predominantly from a private equity fund who bought them probably down the line, somewhere of that history, cleaned it up. And sorry, they didn't buy it from a private equity fund. They bought it from one of the European major electrical business. And they put in the platform for this thing to scale as a launching pad into Africa. And what's interesting is they never really seem to tap the potential, and this was part of a disinvestment program. So they got it at a good price. A lot of capex has gone that they don't have to put into it, and they can scale it very, very nicely. And this is not priced into the business at all.
Okay.
If you just look at it on Conco's basis, CRL's cheap, and you get the rest free.
Okay, so CRL and Rolfs, those are 2 picks. I'd like a third one from you.
So this one may be a little contrarian / controversial, but
crazy. That's another C. Yeah.
Well, here's another C. It's CSG Holdings. So CSG stands for Contract Services Group. It is half. Now this is the interesting thing, because the market views it as a labour broking business, and half of the business is a labour broking business. Very scalable, very cash generative. It is the second biggest labour broker in South Africa, so it is material.
Is Adcorp still the biggest?
Adcorp is.
Still?
If you view it purely on revenue,
okay,
then they are. And CSG would be second. There's Workforce that you could argue was second or third, depending on how you measure it. But CSG, the point I'm getting at is CSG's got scale. The new regulations have come in, they've been fought in the court of law, they've been settled, and life has moved on. And we're expecting this year the labour broking volumes to pick up. And there's the added bonus of agri recovery. Mining seems to be doing a lot better, which obviously absorb a lot of labour. So these guys are very well positioned for it.
And also, over the last 5 years, we've seen lots of rats and mice in the labour broking industry actually getting shaken out. Adcorp is focused overseas extensively. It's diversified its risk perhaps too much. It's brought problems of its own internationally, and so we haven't seen a dramatic re-rating in that share. The stronger rand is now counting against Adcorp, so these guys could be in with a shout.
Absolutely, and getting back to our earlier little point we had, Bruce, about size and quality. So Adcorp is bigger than CSG, but CSG still has scale. CSG, though, has double the margins, double the return on equity, and pretty much half the debt, if you look at it on a relative basis, to AdCorp. So it's actually a better quality business, in my opinion. And I haven't even touched on the other half of the business, which is pretty much a Bidvest-styled industrial service business. They've been consolidating some of the security sector, very good cash flows in there, very good margins. And it's quite simple. The market isn't valuing that part.
Should I mortgage my house to the hilt? Let's say I've got 100,000 Rand capacity in my mortgage or R1 million capacity in my mortgage. Do I take on that debt to buy 33% of these in that portfolio of these companies?
I would say no.
Okay.
The reason being, small caps are volatile. Never use debt to buy them. You have to ride through the down cycles as well. If you have 3 to 5 year view, 10-year view, absolutely. Debt is a ticking time bomb. Debt makes you time sensitive here. You don't want to be time sensitive.
Yeah, but that, the point I'm trying to make is that this isn't the road to riches necessarily. They should deliver above average returns over a period of time. But if you are financially stretched, this isn't like the ads on Facebook for binary options, for example. This isn't the hot ticket to wealth.
Definitely not. But I also wouldn't call binary options that.
no, but it's sold as a hot ticket to wealth. I mean, last year, when we look at the performance of the JSE, we got a big fat 0% return, which is only marginally less than the year before, which we got 1 or 2%. The market's broadly been flat for 2 or 3 years. Small caps, small portfolio of small caps, you probably got 20% a year over the last couple of years.
Actually, you should average a bit higher than that. Last year, small caps did about 15%. Now, there's a lot of distortions at index level because we've had listed property pop up in it. We had gold miners and platinum fall out of top 40 into it. So a lot of volatility. Stripping all of that aside, on average, the average small cap share, and I'm saying average, so it's a big generalization, should return roughly market average, so we call it beta, plus about 5%.
And you're doing it?
Yeah.
Comfortably?
Give or take. Last year, like the small cap fund that run at Alpha Wealth, we generated 8% return, which I'm quite happy with because that's 8% higher than Satrix 40.
It certainly was. I agree with you. Keith McLachlan, fund manager at Alpha Wealth, taking us through the universe, and there is a universe relative to the top 40 of small cap shares from which you can choose in which to invest. We've highlighted just 3 of those. Thank you so much for watching this evening. More Moneymakers tomorrow. Till then, bye-bye.